Welcome, everyone. Thank you for joining our live market Q&A. Kevin and I have lots of good information we're going to go through today. But more importantly, it's about the questions, the concerns. We want to make time for that. So we will talk about what happened. We'll get into interest rates. We'll talk about inflation, our view of what's on the horizon, the recent turbulence, but more importantly, all those questions. We appreciate during times of turbulence, you can have a few concerns, a couple of questions. And that's what we want to do tonight. So if you're on Facebook, you're on YouTube, wherever you're watching, you can type it in the comment section. We can see it. And we'll be doing our best to address all of those questions. But before we get to that, our compliance department, they always make us do this. We got to throw up the disclaimer. Again, tonight, all about the questions, about the concerns. We'll go through some market items, and then we're going to tackle as many of those Q&A items as we can. And by the way, I didn't even introduce ourselves. I guess I should start with that, Kevin. We skipped that whole step.
Always.
I'm Clinton. That's Kevin. We're both portfolio managers. We're both with Becker or Wealth Management, part of Canada Genuity Wealth Management.
Yeah. Basically, anybody who's seen us beforehand, this is not a back and forth episode that we've dealt with before where we cover all sorts of topics. Tonight, we are talking about the market and financials. You can find all that information, though, at our YouTube channel. Please subscribe whenever you get that chance. There's lots of information there that can help you out. Or you can like us on Facebook. Another place to look for us is always our website at beckeror.com. And again, today we want to deal with strictly that sort of market Q&A that we want to answer your questions, any of the financial ones that are coming up that are concerning you at this point in time. And so before we do any of that sort of scenario, we want to know what's going on, what's happening. Clint, that's where we're starting to talk about what's happening, right?
That's right. So again, if you have questions, type them in the comment section. We'll address them. But to start us off, we've talked to a number of clients. We've collected a few common questions, a few common concerns. So we'll start by addressing those, and there certainly can chime in as we go. And that first one, you already talked about it, Kevin. What's happening?
Yeah, I mean, if we do a quick sort of scenario, let's look at 2001. We had a very good 2001 in the markets. Basically, it was a global scenario, but it's specifically, if we take a look at the North American markets and things that we want to deal with on that format, one of the big things is it was a very good year in the fact that we really didn't have a 5% correction anywhere. The line was fairly much on a straight trajectory upward, and we saw that most sectors did really well. Growth started the year well, value came in the middle, there's a bit of a mix towards the end of it, and we saw that the markets performed well for most people going forward. This year at the start, it's been a little bit different. We've had somewhat of a pullback. We've had some profit taking. We've had a variety of different other things going on, things that we can tackle and take a look at. But that's sort of the quick significance of it, isn't this, Clint? There's something that we want to talk about going forward.
Yeah, so we had last year a very calm 2021. Not the case in 2022. We've definitely seen some turbulence, but we have to add some perspective here and a little bit of data to add that perspective. This data here is from Ben Carlson with a wealth of commonsense.com. And it looks at the top table there, the frequency of market pullbacks. A pullback of 5% or worse, which is really all that happened in 2021, happens almost every year. A pullback of 10% or worse, which I'd argue is what we're in the mix of now. 2 out of 3 years, that is the case. So those are still quite common. And then larger drawdowns are actually more rare. And the key difference there between a small pullback and a large pullback tends to be the economy. And that's where this bottom table comes in. Is the economy in a recession or is it not in a recession? We believe it's the top one there, not in a recession. If that's the case, you often see the corrections are shallower and they're shorter lived. And we believe that's what we're in the mix of now, is that non-recessionary stock market correction.
Yeah, a lot of people believe that, since we had such a great year last year, stock market crash is coming. And the first thing that goes through people's mind is, remembering what happened just a few years ago. I mean, I've been through a few of these things. I do remember the tech wreck that happened back in the 2000s. Everybody figured that airplanes were going to fall out of the sky. Every computer you had was going to stop. We weren't going to be able to function as society. So that fear of the unknown really made people panic, and we saw a downward trend. Same sort of thing happened in the Great Recession in 07, 08. Same fear that was coming on. Housing market was collapsing, and it was affecting the global world. What was going to go on? Was it ever going to be solved? We saw that happen. And then finally, the pandemic. Again, we didn't know what was going on, so that fear factor really drives things down fast. So that's the big scenarios that come on. But what we'd be looking at sort of in this time frame is more of a 2018, more of a long-term debt crisis or a savings and loan crisis. Most people don't even remember that those happened. But again, we had the corrections that were there. And that's sort of where we're at right now. Because again, we're not projecting a recession at this point in time. So I would say any sort of pullbacks, we're probably looking at normal market activity that goes on after a substantial year of gains.
Yeah, which is more common. As you mentioned, they're quite frequent. Those 5 and 10% pullbacks are in that vicinity. Often they happen. They're not fun to go through. And then you don't even remember the reason why after the fact.
That's right.
And we could be in the mix of one of those now. A little bit of data to help back that up. This is the St. Louis Fed Financial Stress Index. This is from the US. They do look at multiple items that impact the credit markets, that impact financial stress in the economy. You can see that this peaks there tend to happen when you have an economic recession, like in 2008, last year with COVID, 2020, a big peak. The more important part, that far right corner of the chart is still very low, meaning there's not a lot of financial stress right now in the system. We're not seeing the same kind of economic calamity that we have seen in prior events. So again, go back to that chart we had a moment ago. In non-recessionary times, the pullbacks tend to be shorter lived and they tend to be a little shallower. And this is just kind of adding some evidence, a bit of data to that exact point. So just to back that up, we do have a question that came in here, Kevin. So I'll pull it on the screen and we'll start going through it. This one, thank you again for the question. Please keep asking them. This one's about the Bank of Canada. Is the Bank of Canada going to raise rates like they keep warning us of? So they've told us about it a couple of times. Is it going to happen, Kevin?
I would say that definitely come March 2nd, when the next Fed, or should I say the next Bank of Canada meeting is happening, you are going to get a rate increase. They have been forecasting and forecasting and forecasting. The only thing that's basically held it off, probably from the last 2 meetings, has been the fact that you've gone through Omicron, or you've had something else that's substantial that's come on, that's put a little bit more of a hold on the economy. Now that we seem to be past that phase, and we also came out with information on Wednesday that we hit a new high in the last 30 years for what the inflation or CPI number is at 5.1%, the government's going to have to start to act. I think the bigger question is going to be, are we looking at a quarter point at the next point, or are we looking at a half point raise in interest rates? So yeah, I definitely say that interest rates are increasing. It's going to be sooner than later, and that's definitely something that we're going to have to get used to.
Yeah, so it's not a matter if they're going to happen, it's a matter of when. I would agree with you. It's likely going to be soon. That March 2nd or that early March timeframe seems very suitable. And then is it going to be a quarter point? Is it going to be half a point? I'm not sure, but very likely we're going to see a couple interest rate increases this year. This is a common question that we have gotten from clients, and it's related to the one that was just asked by the viewer. How high will interest rates go? Do you have a prediction? Do you have a forecast? How many rate hikes are you looking at here?
Well, initially, like I said, when we thought that this coming out of the sort of COVID scenario was going to be more of a transitory inflation scenario, we're finding out that this is not strictly transitory. So as we're seeing the inflation rate keeps going up, we see fuel prices going up, we see food prices going up. So as long as that's in there, we have to start to slow things down. So you could see, I would say, anywhere between 3 and 5 rate increases this year. Now, I don't think they'll all be the same magnitude. You could have a large one at first and then smaller ones after that, or vice versa. But I do believe that you're going to have a few rate hikes, because we've got to start to bring back to what that Bank of Canada level is, where they're looking at 2 to 3% inflation, where they like to keep it, not sort of that 5% where we're sitting at right now. So we may still have that for most of the first half, but I think we'll probably be much better in the second half after a couple rate increases. Would you agree?
Yeah, we could be in that period where inflation is peaking. Are we at the peak? I don't know. And I'm saying this for Canada as well as the US. Like, inflation could still get a little higher here before it starts to taper off. And interest rate increases, at least the expectation of and the early follow through of those rate hikes, will be what kind of scares off some of the inflation. And I'm in the same boat as you. Multiple rates is likely. Where they all end up, I'm not sure. I have a feeling we'll do a couple, and then they'll probably judge to see the reaction of that. And we have a follow-up question here. This relates to rates, it relates to inflation, and it ties it all back into kind of mortgages and housing here. You can see the question: locking in for 5 years. If you're going to get all those rate hikes, should you lock it in? What's your view, Kevin?
Well, it's definitely not a bad scenario for a lot of people. It also depends on, do you want that fixed rate knowing you're going to have that going forward? If you lock in for 5 years, you know what your payment is. But again, a lot of the times, depending on how high that's going to go, a variable rate may work for some people as well. I mean, if we're only looking at maybe a full point over the course of the year, is that better or is that worse? But yeah, I would say that it's definitely that time to consider what to deal with interest rates. We are historic lows, and that's always a nice thing to see. People go, well, okay, if it's 2.5 now, is it really a big deal if it goes to 3.5? It can be. I mean, now you're talking a 30% increase in what your interest rate is, as opposed to if it was 15 going to 16, that's not quite as dramatic with a 1% increase. So it's definitely something I think we should consider. What do you say?
Yeah, I'd be in the same boat. Rates are clearly going to go up. You have to keep in mind they are quite low.
Yep.
So if you have a variable rate, you could probably go through a few hikes before it'll actually get to the level of a fixed rate. So I personally wouldn't rush in to lock in today, but
Yep.
it's certainly something you'd want to keep in mind. So we do think rates are going to go up, and eventually you'll get to that tipping point where a fixed will probably be a better deal than a variable. So if you're more comfortable just knowing your payments and taking some of the uncertainty out of the equation, then absolutely a locked-in mortgage right now would make some sense. This does tie into a question we get quite often from clients. Common concern, I'll pull it up on the screen here, relates to the housing market. Housing market has been on fire. You talk to anyone that's had to buy a house in the last year and a half, last 2 years, it's been crazy trying to first see what's available. You find what's available, and suddenly there's like 7 offers on the house, and it goes for $50,000 more than asking. If rates start to go up, is that going to have an impact on the housing market? Will we see a drop?
No, I don't think you're going to see a massive drop by any stretch of the imagination. As you said, I mean, the biggest factor with the housing market, interest rates are always nice and they have a little bit there, but the biggest factor going is the supply and demand. Do we have twice as many people looking for half the amount of houses? Then it doesn't really matter what the interest rates are. If people can afford to pay for it, they're going to still buy houses. They're going to still drive the market up. But if all of a sudden we start seeing that, rates are coming out and people want to get out fast and we flood the market with a whole bunch of supply, if it meets the demand, then we could be flat for a while. If rates go too far, too fast, you could also see a bit of a drop. I would not forecast, though, anything that would be vastly dramatic. I mean, I don't see the housing price in Toronto going from sort of 1 million all the way down to 500,000 anytime soon. Okay, that would be sort of a dramatic drop. But you could have a couple thousand here or there, 10 or 15 one way or the other, depending on where the housing market is. But yeah, I think the interest rates will have some impact, but not enough to stop the drive.
Yeah. And for those just tuning in, we've taken a couple of questions here. We talked interest rates, inflation. We're now asking or answering a common question about the housing market, how all that will impact the housing market. I would agree. You're unlikely to see a massive drop. In Winnipeg, if a house is 500,000 is going to be worth 300,000 in 2 years. Probably not. Could you see a bit of a flat line or slower growth or even a slight drop? All of that's certainly possible. I think that'd be more probable. But I think a key factor is you have a massive wave of demand. It's demographics. You have all the millennials, all the Gen Zs, those are people in their kind of 20s to 40s, broadly speaking. That age range actually outnumbers the baby boomers in Canada. So it's a massive wave. And they want to live somewhere. They want to have families. They're in that part of their life where you tend to see that they need a little more space. So they're looking for a house to buy. So you have a massive amount of demand, a huge demographic force. And then we're not even having talked about there's going to be more people coming to the country, more people moving within the country. So your urban centers are going to see level of immigration. Plus you have the demographic wave for all the people that are already here. That's a lot of buying power. That's a lot of demand. And I think that's going to sustain the real estate market for a while. So the issue, in my opinion, longer term has more to do with supply. Interest rates are going to slow some of that demand, but it's certainly not going to take it away. So the idea that rates, the housing is going to collapse, certainly not in Manitoba. Other parts of Canada could see more of a decline, but I don't think it'll be a massive crash. Nothing to that magnitude, at least not in my view.
No, and we're not getting any of that sort of scenario that you had in 07 or 08, where it was a whole bunch of teaser mortgages or there was ninja loans and everything else, where anybody to get a house was there. There's more in place to provide that won't happen again. So I agree with you. I think that supply demand is the biggest factor to ever take a look at.
Yeah, we're talking rates, we're talking inflation. We wrapped in the housing market there. A related question, we've heard this one a lot, certainly lately, all the stimulus, all the monetary programs from both the monetary practice as well as the financial policies. So it comes to a question of debt. You have a high level of national debt. You can also think of this as kind of a consumer debt. Are those high debt levels, Kevin, going to be a concern?
Well, I think they have to be sooner or later. Now that we're talking that there's inflation out there and we are talking about Bank of Canada raising interest rates, everybody beforehand has always gone out now in the last little while and gotten what they can money-wise, because basically there's been no cost to borrow. I mean, if you're looking at, a 2% interest rate or a 1.5% interest rate, it's really not costing you much to borrow $10,000. I mean, $150 a year seems like a reasonable cost to be able to deal with. And of course, our government's done the same sort of scenario. And hey, I can push it down. It's really low and cheap to buy at this point in time. And again, the problem that you have with that is it pushes it further down the line. Sooner or later, the bill does come due. And that's what we're going to start to find now. So, I mean, if all of a sudden, as people have mentioned with mortgage rates, they're a little more concerned. Your credit card rates, well, maybe that's something that goes up. Not that it's likely, they're high already. But, lending for lines of credit or things along those lines, they will be adjusted. And the amount of debt that we have on the books right now, if it's just serviceable, there could be some problems. But again, is it the biggest concern in the world? I think we've managed to taper some of that. We do have high debt levels, both personally and in the government, but we're nowhere near some of the places that were worse. I mean, Greece was a disaster. The United States has substantial government debt compared to what's going on out there. So I believe that high level of debt's definitely a concern, but I don't think it, as we said with the housing market, I don't think it's panic mode just yet.
Yeah, a couple of items to add to that. One, in terms of the government debt, the servicing level is still not outrageous, so they can still handle the current level of debt without having a big problem. And I think they can handle a couple of increases in rates and still being in a qualified servicing level there. So in my view, the government level debt is more generational. I'm not a big fan of it, but I don't think it'll be an issue that we have to deal with in the next 5 or 10 years. Probably something you have to deal with in a longer time frame, which really passes the buck to the next generation. Not saying that's good, but just in terms of investors, is this a concern you have to worry about tomorrow? Probably not. On the personal side, we have to remember all the debt, at least in Canada, the biggest piece of the consumer debt, it's mortgages. So it's connected to assets. It's not as if it's just credit cards and lines of credit. They're buying houses, and houses are expensive, so they need big mortgages. So at least they're adding something to the balance sheet. So there is an asset connected to it. So it's a little bit different. So it's not completely unhealthy. So again, time frame when it comes to the high level of debt, it's not something we have to worry about for tomorrow. In my view, it's kind of a longer time horizon item. So I wouldn't be planning my investments or my retirement plan around the high debt level. I don't think that would factor in to that time frame when it comes to the investments. And a reminder for the questions, whether you're on YouTube or Facebook, simply type them in to the comment section. We would love to hear from you, love to answer any questions you might have. We're going through some of the common ones we've heard in the last couple of weeks. We'll bring it back to the markets here. We've talked interest rates, we've talked inflation, we talked about housing. Back to the rates and inflation, Kevin. In your view, what does that mean for the markets? What does that mean for, are there some sectors better than others? If you had to paint a picture there, what would it be?
Well, yeah, I mean, basically when interest rate increases, I mean, the theory always behind it has been as interest rates increase, the market's going to come down. And that's basically what it is, because all of a sudden GIC and bond rates become much more attractive. I'm going to put money into something that is paying me a guarantee, and I don't have to worry about my principal, as opposed to something that may go up or down and may or may not pay me. That's the theory. But it doesn't always work out that same way. I mean, we've had times where we've seen a variety of different things go on where the market actually has been a very good hedge against the inflation and the interest rate scenario because of what they've done. And that's an area to take a look at. So I would not be panicking anything and sort of switching it around dramatically. I mean, you don't want to jump out of your bank stocks and jump into a GIC tomorrow. I mean, that's probably not the area. I mean, we're not getting interest rates increasing that much. But I would say based on where things are, if interest rates go up, I think the markets still have some time to play. Again, it's not strictly based on what rates do. There's other factors. There's earnings and a variety of different other things that the market deals with, that as long as it's still chugging along and the economy's still moving well, you're going to find things along those lines that play out.
Yeah, that certainly covers the topic there. So we're talking inflation, interest rates, what that means for the markets for those that just tuned in. An item that kind of ties in with what you talked about is commodities, because typically in every cycle is different. I don't want to say like the future is going to be a replica exactly of the past, but there is certainly some value in looking at data in the past. And last time we had a higher inflation, rising rate environment was kind of that 02 to 07 zone. And in that zone, you had financials doing well. Your big banks, they tend to make more money when interest rates go up. And you had a commodity cycle. Oil prices went up. Most of your agricultural commodities went up. And we're seeing a little bit of that now. So it kind of ties into that might be the theme this time around as well. This is a chart from All Star Charts done by JC Peretz. And you can see the cycle here. I have to explain the graph a little bit. When the black line goes up, that means the stock market is outpacing your commodities. In this case, the S&P 500 versus the CRB index. So stock market doing better than commodities. Black line goes up. Black line goes down. That means the commodities are doing better than the stock market. And you can see the black line went down there in the early 2000s, that kind of 02 to 07 period. And then the opposite. Then for the last decade plus, commodities were not the place to be. It was all about the stock market. And then you can see just the last 2 years, that has started to change. Really, since the pandemic hit, March was ugly. Oil prices actually went negative for a brief period of time. And then spring 2020 onwards, commodities have been outpacing the stock market. So just recently you've seen, could it be a longer commodity cycle? Certainly possible. I'm not sure, but it fits that theme of higher inflation, that theme of rising interest rates. Commodities tend to do well in that environment, like we saw in that 02 to 07 period. We could be seeing a replay of that now. And we've been talking about the stock market turbulence, what we went through recently, which I think we're still in the middle of.
Yes.
Well, during that time, those areas, your financial companies, your energy companies, have actually done well. They've been an area of strength despite the market turbulence. So that has been one thing to keep in mind. And I don't think we can get through this event without talking about some of the current items, Kevin. And it's been all over the news. It's hard to avoid Russia, the Ukraine. What does that mean for the markets? We've had this question a couple of times. So why don't we address it? What about Russia and the Ukraine?
Yeah, I mean, dealing with Russia and the Ukraine, obviously there's going to be some effect on the market to a point, but there's going to be certain areas that are affected a lot worse than others. As Clint has just mentioned with all the commodities and everything else, if we've seen on the commodity side of things beforehand, usually after we've come out of a large pullback, you start to see the commodities come around. But again, the demand decreases. So obviously the oil is decreasing for the amount you put out. All of a sudden, when demand increases, the supply is not there, prices go up. So we've been seeing oil prices going up. And of course, anytime you have a conflict that involves a nation that has a large supply of energy, such as Russia, you're going to find that if it escalates, all of a sudden supply is constrained, prices go up. But in the general market sense, a lot of these events don't really have a large impact overall on the market for a long period of time. It's usually, as we've said beforehand, you remember the big crashes, but you don't remember the savings and loans. You don't remember the long-term debt. 5 years from now, you won't remember the Russia-Ukraine conflict probably. And there's definitely evidence that we have that can prove this, isn't there, Clint?
Yeah, I'll pull up some data. This is from Ryan Dietrich, LPL Research, and he did a long list of different geopolitical events we've seen. It goes back all the way to the World War II times. This is a very long chart, but many of the events you might think of like, oh yeah, I forgot that happened. And you'll notice the drawdowns, the average is about 6%. Like we talked about, 5% happens almost every year, 10% drawdown, 2 out of every 3 years. So 6 is very frequent in the stock market. And then the time to recovery is not that long. It's measured in weeks and months, not in years. And lots of those geopolitical concerns we've seen in the past. Again, small blips in general tend to be shorter term. And we think Russia and Ukraine likely will fit a similar trend as that past data, which kind of leads to the question. We're saying generally there's some turbulence. We're seeing higher inflation. We're seeing likely rising interest rates. That could mean a little more of a commodity, more of a financial play that we've seen. We're saying geopoliticals aren't as big of an issue for the market longer term. Kind of leads the question is what is important to the market longer term, Kevin? And I'll pull this up so you can chat to it.
Yeah, basically, no matter what we ever want to talk about, whether it's a political event, whether it's bombings, whether it's COVID or anything else, the thing that actually drives the market in the long run is earnings. If companies continue to provide good earnings or upgraded earnings, then you're going to find that these companies are going to continue to move up and up and up, because that is the basis for why you're buying something in the first place. You're looking at a company that you're hoping is going to continue to grow, continue to grow, and continue to grow. And if they are producing better and better earnings, the chances are their stock price is going to go up with it because it validates why you've gotten it in the first place. And this chart here basically shows exactly that, looking between the operating earnings and the stock market index over that time frame. You'll see that it's not completely correlated, but they basically travel in the same trend. And we are dealing with a market, look here, that is at least 20 years old that we're going to deal with. So this is not sort of a short term. We're picking it on the last 3 years to see what goes on. We are finding that earnings basically are driving the market. Isn't that sort of the scenario we should be looking at?
So this shout out to Tony Dwyer, our chief strategist, as well as Ned Davis Research. They're the ones that did this chart. It goes back to the 80s to give you a time frame, a couple of decades.
Yes.
And the blue line is essentially their earnings per share. So how much money are companies making on average? The red line is the actual stock market. They're not perfectly in sync. There's short-term divergences, but long-term, they tend to follow the same path, which makes sense. Companies make more money longer term. You tend to see that reflected in the share price. And that's kind of the idea. So the geopolitical situation, short-term turbulence, perhaps not a longer-term event. Rising rates, inflation can be an issue like we talked about, but perhaps, again, more of the shorter term, not so much a long-term item there. Again, feel free to ask questions if you have them. We've been going through some of the common ones we've been receiving the last couple of weeks. We're happy to take some extra questions, whatever's on your mind, whether it's a financial item, inflation, interest rates, the market's turbulence, whatever it is, let us know. Type it in the comment section. We're happy to go through it. And we've got a few more here, Kevin, that are common that clients have asked us. Maybe this will be a demographic one. Maybe I'll have to answer it, or maybe you can give your
More
perspective,
so.
but not so much about what's happening right now, but a common question we get that's related has to do with cryptocurrency. What's your view on crypto?
Yes, cryptocurrency, or as some people may call it, the digital gold, or depending on how they want to take a look at a variety of these things. Crypto has become very popular over the last little while. And again, you're right. The millennial and Gen X understands this a lot better than, say, the baby boomer or Gen Y generation does, because they've grown up more on the fiat currency. They're not established with the blockchain technology, and they're not really sure. All they see is, well, Bitcoin's moving. And again, we are dealing with something that really has limited regulation compared to what's really going on out there at the moment, and does have some violent swings one way or the other. So, $60,000 one day, a month from now, it could easily be 25,000, or it could be 80,000. So that's sort of a, be careful as to what it is. And the crypto market is not just Bitcoin, is it? It involves a lot more than that.
It certainly does. Over 17,000 cryptocurrencies currently out there. So if you think of it, cryptocurrency, Bitcoin, I get that's probably the common link, but
Yep.
Much larger market. I've been saying recently, cryptocurrency, if you focus on the currency, you might be missing part of the story, because there's a lot of technology there about what they're developing. You can talk about the metaverse, you can talk about DeFi and all the pieces there, the blockchain technology. I think it's better to view it almost as technology companies, upstart tech companies. Some of them are going to make it, maybe. Some of them might just disappear tomorrow. Also possible. So you have to be cognizant of the risk there, but lots of potential in that space. So think about it. You're looking at upstart technology companies. Some of them might do very well. Some of them might not. You have to be cognizant of the risk. And if you're comfortable with the level of risk, maybe add a little bit to your portfolio, but by no means is this say everyone's got to own it. Not the case, in my view. Still pretty early in the development stage there for cryptocurrencies.
Yeah, we're getting more questions on that nowadays. If this had been 3 or 4 years ago, it would be the same thing in the cannabis industry. What should I be doing here? What should I be doing there? So every time we see that there's certain things that go on in markets that are going to redefine how certain areas are looked at. Do we keep the same standards? Do we look at just the technology sector? A variety of different things to take a look at. But you're right, that crypto sector is definitely going to be coming more and more into play. And defining what it is, as you mentioned, is the biggest factor.
Yeah, and we'll wrap up here. Again, if you have a question, just throw it out there. We're happy to tackle it. But some of the questions we've talked about was interest rates, inflation, the market turbulence, where we think things might be heading. That kind of falls into place. An investor might be thinking, Kevin, what should I do? And this is in the environment. We're going through some turbulence. High level, what would you be doing?
Yeah, I mean, basically where it is, you've got to evaluate the market for where it is. But again, it's not just strictly, am I investing in this? I mean, what's your plan overall? Do you have something set up? Is it long-term? Are you looking for short-term investments? Again, Clint's mentioned this beforehand. What I should do is sort of looking at am I just using the savings portion of my TFSA? There's a variety of different things you can put in there, and people don't really know about it. So what I should do is going to depend on what are your goals. Are we looking for an investment for your retirement? Are we looking for vacation investments? Are we putting away for the buying of a house? I mean, there's a variety of different things. If I'm dealing with a market in particular, I would definitely say that, watch what the interest rates are doing. Don't be discouraged to say that, okay, well, if interest rates are going out, I got to get up, the world's coming down to an end scenario. It's not that way. All they're trying to do is slow down the inflation areas that are going on. We've had supply chain constraints and everything else. These eventually will work their way through the system, and it's something that we should definitely consider. But again, I would be looking at certain areas on a high level sector. Commodities look good now. Energy is a nice sector to be in. I mean, if you're looking at that sort of, defensive plays because interest rates are going, that's another area that could move. There's other things beyond that we should be looking at, isn't there, Clint?
Yeah, you always have to do it in the context of your plan. Like, what is the goal? I know short-term items, interest rates, inflation, they go, what's good in a rising rate environment? What's good to hedge inflation? Which nothing wrong with incorporating some of that in your portfolio, but no one invests with that as their ultimate goal. Typically, the goal is I want to retire, I want to create income, I want a legacy for the next generation. You always have to have that goal in mind. So it normally means a longer-term time frame. But in this environment, like you talked about, financials tend to do well. Banks, insurance companies, rising rates tend to work in their benefit. We've seen before that 02-07 period, commodities tend to do well when you have higher inflation. Like you mentioned, we could see a bit of that now. That has been the case. So you could lean a little more into the relative strength. And then outside the stock market, some private debt, private equity, particularly on the real estate side, some private equity in the real estate. Normally, as you see inflation, well, rents don't go down. Often rents go up. And that's how they can hedge inflation. They charge their tenants more money. And if you're an owner of that apartment block or owner of that rental, well, that's to your benefit. So you could be getting a bit of an increase there. So that's something we're looking at as well. But again, all in the context of your overall goal. You don't want to simply invest for that particular purpose. You want to make sure it's in context of your goal. And we had another question come in, taking us back a topic here, going back to crypto.
Sure.
Good question here. Are crypto profits taxed? I imagine if you've been trading cryptocurrency, you've had a big increase in 2020, a good one in 2021. Maybe you got some profits there. I'm actually not sure. I think in Canada, it does have to be claimed as capital gains, but I'm not the tax expert, so I'm not sure if that is the case. But I'm confident if it's not taxed now, it probably will be in the future.
Yeah, exactly. And the accountant's probably the best person to check with. But again, even some of them may have to be consulting the CRA people to find out exactly how this is done.
Exactly. And we didn't want to go too long. We wanted to take 25, 30 minutes, go through some of the common questions we're receiving, tackle some of your questions. And we haven't done that. We'll stick around for a little longer. You can still type questions into the comment section if you like, and we'll certainly tackle them. But if you want to reach us offline, prefer not to ask in front of everyone, you can do that too. Chatwithclintonkevin.com. It's part of our website. You can simply fill in a form there and reach out to us. We'd love to hear from you, whether it's on the markets, maybe it's on financial planning, whatever the topic, let us know. We would certainly love to chat. Anything you want to add, Kevin?
Yeah, and I will do the shameless plug for the end of it. Beyond what we've talked about in the market today and what's going on, we do have a variety of different topics on our website and on our YouTube channel, dealing with things from CPP, as Clint mentioned, financial planning, retirement. We have an entire section dealing with cryptocurrency and what's going on there, an entire section dealing with the housing market. So these are things that a lot of questions that everybody always wants to know about. So make sure that you can visit, see what's there, and we're more than happy to answer any questions that you've had on that or anything else going forward. So I think that's everything that I wanted to touch base on. Anything to finish off?
I think we covered it all. So thank you, everyone, for watching. We will make this replay available, so you can always come back to it on our YouTube page. And if you have any questions, chat with ClintonandKevin.com. Have a good night.